Hey, so another question that comes up a lot with our buyers is, what is mortgage insurance and when do I have to get it? Elena.
Mortgage insurance is literally insurance against a loss. So anytime you put anything less than 20% down on most loan types, you have mortgage insurance. And it is literally a monthly fee that is paid into these entities that are either the government reserves that help pay for those foreclosures or the private reserves that come with private mortgage insurance that are held against conventional loans that back up any losses for the banks there.
Okay, so can you get rid of it? How do you get rid of it? Because a lot of questions out there about FHA versus conventional, and they get to a point where they have more than 20%. Can they get rid of it, and how?
I'll touch FHA because that one has the most common misconceptions. A lot of people believe that to get rid of mortgage insurance on an FHA loan, you have to refinance out of it. And most loan officers do say that simply because statistically, most people don't stay in their mortgage loan for 11 years. Once an FHA borrower has hit 11 years and they have 20% equity, they actually can call their servicer and ask for an appraisal to get rid of the mortgage insurance.
Question about it. So they have to actually order the $500 to $600 appraisal and pay that themselves?
Correct? Yes.
So there's no BPO, which is a broker's opinion. You can't get it unless you hire an appraiser to get it.
Right, but you have to be careful about taking the lead on that yourself. It has to be done through your servicer. So if, for example, Chase Bank is servicing your loan, you have to talk to them and find out their steps to help get rid of your mortgage insurance because they do vary differently bank to bank.
Okay, so what about conventional? What are the rules for getting rid of mortgage insurance on a conventional loan?
Conventional does have a bigger advantage when you're looking at getting rid of mortgage insurance because again, a common misconception is that as soon as you have 20% equity on a conventional loan that you can get rid of the mortgage insurance. That is not in fact true. You have to have had made 24 months payments. Once you've reached that mark and you have 20% equity, again, it's a simple call to your servicer to get through the steps with them. And it is not as fast as a refinance, but it's definitely worth putting the legwork in to get it done for you and your family.
Okay, and then last question is, what is the difference? Because I hear a lot of terms, PMI versus MI. So that's a big discussion.
MI, just the acronym, lots of real estate acronyms. MI, mortgage insurance, is just mortgage insurance from the government-backed entities that we talked about, FHA, USDA, VA. PMI is private mortgage insurance, again, for these private banks. It just covers the conventional pocket of all banks, and that's where you hear the acronym PMI commonly.
Okay, I know I said last question, but I do have one more question.
Sure.
Where does the money go? So this bank is collecting $200 to $400 a month from you for mortgage insurance or private PMI. Where does that money go, and what happens when you sell your loan or refinance?
I love this question because it's a really important thing that it likely will change how some of loans work right now. It literally sits in what's called the reserve. So FHA currently has an excess of reserves. So what does that mean? They've been collecting so much monthly mortgage insurance from FHA borrowers that they have an abundantly large amount of money to cover foreclosures. So that means what they're likely going to do is reduce the monthly mortgage insurance cost for FHA, which is, great news for buyers. But it does all sit in regulated accounts. It's not like the banks can use the money for anything else. They hold it there in reserves to help cover those foreclosures or short sales.
Awesome. Awesome discussion, because that is a question we get a lot.
Right.
So thank you.
Yeah.